Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TD SYNNEX Corporation quarterly report. TD SYNNEX Corporation offers a wide range of businesses and services that cater to the information technology (IT) ecosystem. At its core, the company provides distribution and solutions aggregation for various IT products and services. The company's endpoint solutions include personal computing devices, peripherals, mobile phones, printers, and supplies. It also offers advanced solutions such as data center technologies, including hybrid cloud, security, storage, networking, servers, software, and converged infrastructure. In addition to these core offerings, TD SYNNEX Corporation provides various value-added services, including design, integration, test, and production support. This includes thermal testing, power draw efficiency testing, burn-in, quality, and logistics support. The company also offers logistics and field services, depot repair, customer management services, and cloud services. Furthermore, TD SYNNEX Corporation provides online services, financing options, marketing services, and device-as-a-service to end users. Its marketing services include direct mail, external media advertising, reseller product training, targeted telemarketing campaigns, national and regional trade shows, trade groups, database analysis, print-on-demand services, and web-based marketing. The company serves a diverse range of customers, including value-added resellers, corporate resellers, government resellers, system integrators, direct marketers, retailers, and managed service providers. With its extensive portfolio of businesses and services, TD SYNNEX Corporation has established itself as a leading player in the IT ecosystem. TD SYNNEX Corporation market capitalization of $16 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that TD SYNNEX Corporation holds a significant advantage in their industry. TD SYNNEX Corporation trades at a lower price-to-earnings ratio of 16 times and a higher price-to-book ratio of 1.75 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has aggressively reduced its share count by more than 5%, while revenue, profits, and assets have grown. This represents a very favorable capital allocation strategy, with management materially increasing per share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the key statistics and trends presented in the summary. Revenue growth is primarily driven by several factors. Firstly, the company's expansion into mature and developing markets has led to an increase in revenue from its Unify Reach portfolio. Additionally, end market demand for IT products has contributed to revenue growth. The company's consolidation efforts have also yielded significant results, with a $2.6 billion increase in consolidated revenue driven by growth in advanced solutions and endpoint solutions distribution portfolios, as well as Hive solutions. Furthermore, the company has experienced strong growth in manufacturing and assembly sales, supply chain services, and higher mix of sales under customer-owned procurement models. This is evident from the 18.1% revenue growth recorded in 2026 compared to 2025, driven by an increase in revenue and gross margin expansion in advanced solutions and endpoint solutions distribution portfolios. On the other hand, revenue decline can be attributed to a few factors. Firstly, cost of revenue increased by $1,375,351, which has negatively impacted revenue growth. Additionally, revenue from Apple, Inc. decreased by 1%, contributing to revenue decline. Furthermore, a decrease in sales volumes was recorded between November 30, 2025 and February 28, 2025. In terms of segmental performance, the Americas distribution segment experienced a revenue growth of $7,773,442 in 2026 compared to 2025, driven by growth in advanced solutions and endpoint solutions portfolios. The Europe distribution segment recorded a 25.8% increase in revenue due to growth in distribution portfolio and favorable impact of changes in foreign currencies. Similarly, the APJ distribution segment experienced a 29.8% revenue growth driven by growth in distribution portfolio. Overall, these statistics highlight the key drivers of revenue growth or decline for the company, providing valuable insights into its performance across different segments and markets. Net income experienced a significant increase of 95.1% from $167,537 to $326,915 over the given period. This substantial rise was also reflected in the net income figures for the subsequent year, which showed an increase of 25.5% from $998,006 to $1,252,146. The profit margins also underwent a notable change during this time. The gross profit margin rose from 6.9% to 7.3%, indicating an improvement in the company's ability to retain revenue after accounting for production costs. Furthermore, the operating income margin increased from 2.1% to 2.8%, signifying enhanced operational efficiency and profitability. The non-GAAP operating margin also experienced a significant increase from 2.74% to 3.44%. This improvement can be attributed to several factors, including revenue growth in key distribution portfolios, such as advanced solutions and endpoint solutions. The expansion of these portfolios led to an increase in gross profit due to higher sales volumes. Additionally, the company's manufacturing and assembly sales witnessed strong growth, contributing to the overall rise in profitability. The company's debt level has experienced significant changes over the past year. According to the extracted summaries, short-term borrowings increased by $109,961, and total outstanding borrowings rose from $4.6 billion to $4.7 billion between November 30, 2025, and February 28, 2026. This represents a substantial increase of approximately $110 million in debt level. However, the interest expenses have shown mixed results. On one hand, there are instances where interest expense and finance charges net decreased by $1,346 and even experienced a 10% decrease from 2025 to 2026. On the other hand, another instance shows an increase from $2,523 in 2025 to $2,464 in 2026, which is a slight decrease of 3%. The conflicting information regarding interest expenses makes it challenging to determine if there has been a significant change in this area. In conclusion, while the company's debt level has increased significantly over the past year, the interest expenses have shown mixed results. Further analysis and clarification are needed to accurately assess any changes in interest expenses. The company's performance across various segments and regions has been mixed in recent times. On a positive note, the Americas distribution segment saw a significant increase in revenue of $1,536,270 from the previous year. Similarly, the APJ, Asia Pacific Japan, distribution segment also experienced growth, with an increase of $999,588 in revenue. Furthermore, the Hive Solutions segment performed exceptionally well, with a substantial rise of $2,150,996 in revenue. However, not all segments and regions fared equally well. The Europe distribution segment was one of the underperforming areas, witnessing a decline in revenue of $6,237,172 compared to the previous year. This stark contrast highlights the need for the company to reassess its strategies and focus on improving performance in these struggling regions. Management is optimistic about the company's future growth and demand for its services. They believe their business model will help partners maximize technology investments and achieve business outcomes. To maintain its position as a leading global distributor, solutions aggregator, and original design and contract manufacturer, the company plans to continue investing in IT systems and hiring key personnel. The company's vision is to become a vital solutions aggregator and orchestrator, connecting the IT ecosystem. To achieve this, management has identified 5 strategic imperatives: unifying reach through targeted go-to-market strategies, targeting new customers with tailored value propositions, expanding addressable markets, diversifying offerings within its portfolio, and expanding service capabilities. In addition to organic growth, management is open to expanding operations through investments or acquisitions to increase market share and better serve customers. This expansion will be funded by existing cash, borrowings, or securities issuance. Overall, the company's strategy focuses on innovation, customer satisfaction, and strategic growth initiatives to maintain its leadership position in the industry. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts, with cash dividends declared at $38,742 in 2026 and $37,220 in 2025. This demonstrates a commitment to rewarding investors for their loyalty. In addition to paying dividends, the company has also engaged in share repurchases. Specifically, it has made repurchases of common stock for tax withholdings on equity awards, totaling $3,576 in 2026 and $4,250 in 2025. These actions indicate that the company is proactive in managing its capital structure and prioritizing shareholder value. There are valid concerns about inventory buildup and supply chain disruption. The data suggests that the company is experiencing issues with its distribution channels, particularly in the Americas region. A significant increase in cost of revenue by $357,067 on page 26 indicates a potential problem. Furthermore, negative cost of revenue amounts on page 27 raise red flags about inventory buildup or supply chain disruptions. This could be due to overstocking or inefficient logistics, which can have severe consequences for the company's bottom line. The days inventory outstanding, DIO metric, also reveals a concerning trend. The DIO increased from 53 days to 62 days as of February 28, 2026, indicating that inventory is taking longer to sell and potentially building up. This could be a sign of inefficient supply chain management or overproduction. Additionally, the company's decision to increase inventory levels to support growth in business, page 41, may have contributed to the buildup. While this move was likely intended to meet growing demand, it has led to increased costs and potential disruptions in the supply chain. Overall, these indicators suggest that the company needs to address its inventory management and supply chain issues to avoid further complications. That concludes the financial summary for TD SYNNEX Corporation. Feel free to comment below, and I will be happy to answer them when possible.